Look, I'm going to tell you something that sounds insane, something that goes against every brochure your wealth manager has handed you in the last 5 years. For years, the entire corporate credit market has built itself on a single unwavering assumption. If a loan or a bond carries an investment grade rating, it must be safe. It must be solid. It must be something you can bet your retirement on. We look at that BBB rating or higher, and we sleep soundly, believing the bedrock of the American financial system is intact. But that assumption is a lie, and it has become, in the words of the chief investment officer at PIMCO, one of the largest and most influential bond managers on the planet, very, very dangerous. I'm not here to fearmonger. I am here to read you the data that the mainstream financial media is too busy glossing over. We are standing on top of a $1.3 trillion landmine called private credit. Moody is now explicitly saying that this sector poses a systemic risk to the U.S. banking sector. We are watching billions in private credit begin to unravel as we speak. This isn't a probability, it is a process that has already started. At this exact moment, the global credit markets are being reshaped by forces we haven't seen in almost a generation. We are witnessing the explosive rise of private credit, the simultaneous retreat of traditional banks, and, perhaps most terrifyingly, the fading ability of the Federal Reserve to effectively act as a market backstop. If you think 2008 was the end of banking crises, you aren't paying attention. What is emerging now is a financial ecosystem that is bigger, faster, more complex, and in many ways more fragile than the pre-2008 world. You need to understand what is happening to your money before the gates close. To understand where we are going, we have to look at the rearview mirror. History doesn't repeat, but it rhymes, and right now, the rhyme scheme is terrified. The last credit crisis back in 2008 swamped many of the biggest banks. We all remember the carnage. Liquidity dried up, interbank lending froze, and the global economy stared into the abyss. In the aftermath, regulators stepped in. They tightened the screws on big banks. They made it harder, more expensive, and more bureaucratically painful for banks to lend to risky corporate borrowers. And as the banks scaled back lending, fund managers saw an opportunity. Nature abhors a vacuum, and so does Wall Street. When the banks stepped back, the shadow banks and the private credit funds stepped forward. They saw a chance to provide private credit to companies that the banks were now too regulated to touch. It started as a niche, a way to get yield in a zero interest rate world. But this new business grew rapidly. Today, U.S. private credit totals some $1.3 trillion. To put that in perspective, that is nearly half the size of the $2.7 trillion in commercial and industrial loans made by commercial banks. We have effectively built a parallel banking system. The narrative sold to us was simple. This makes the system safer. In theory, one would assume that moving risk away from deposit-taking banks to private funds would insulate the system. If a hedge fund blows up, it's just rich people losing money, right? The contagion shouldn't spread to your savings account, but that theory is dead. In reality, those banks that are overexposed to private lending are now in uncharted territory. Why? Because the banks didn't actually leave the casino, they just changed seats. Does this sound familiar? Does this sound like a rerun of the pre-2008 financial crisis? To many veteran credit investors, the current landscape looks eerily familiar. It reeks of the same complacency that preceded the great financial crisis. In 2007, we trusted the ratings. We trusted that the risk was diversified. We trusted that the banks were hedged. We were wrong. And PIMCO is trying to warn us that we are about to be wrong again. Let's strip away the narrative and look at the cold, hard math. The fundamentals of this market are screaming danger. The core rot in this system is leverage. In a healthy market, a lender lends money they actually have. In this market, everyone is borrowing to lend to someone else who is borrowing. The underlying borrowers, the private credit funds, and the fund investors have all taken out loans, often from banks. Here's the data point that should keep you up at night. Moody's ratings estimates that U.S. banks have lent $585 billion to private credit and private equity funds. But that's not all. They have extended a further $340 billion in commitments to both. Think about that. We are talking about nearly $1 trillion of bank capital tied up in the shadow system. U.S. banks, with the most exposure to these non-bank financial institutions, are also the ones most dependent on markets for their funding. This creates a liquidity trap. If the market freezes, these banks are the first to fall. And how are we assessing this risk? PIMCO points out a very simple but unsettling problem. Investors are increasingly outsourcing their judgment to rating agencies. We know from 2008, that we cannot truly rely on those ratings 100%. Yet, as private credit grows and competition intensifies, many investors have stopped doing deep credit analysis. They have essentially stopped doing their due diligence. Instead, they rely on whatever grade appears on the paperwork. If it says investment grade, they treat it as safe. It's laziness, born of a decade of easy money. Here is the unusual loop that has been created. 1. Banks retreat from risky corporate lending. 2. Private credit steps in to fill the void. 3. Banks then lend to the private credit funds themselves. It is a game. It is diversification on paper, but in reality, it is just added leverage, less transparency, and more complexity. The risk hasn't left the bank's balance sheet. It has just been obscured by a layer of fees and a different corporate structure. We are already seeing the cracks. Bloomberg reports that already this year, more than 1 in 10 private credit borrowers are deferring cash interest payments. Let that sink in. 10% of the borrowers can't afford to pay their interest in cash. They are likely paying in PIMCO, payment in kind, essentially paying debt with more debt. At least 45 firms have been taken over by their lenders this year, the most in 6 years. Pools of private credit loans managed by giants like BlackRock and Blue Owl Capital are showing signs of distress. This is not a forecast. This is the current reality. Why this time is different? The bulls will tell you, we've handled defaults before, but they are missing the structural shift that makes this time uniquely hazardous. The deeper issue is the structure of the credit market itself. 1. The invisibility cloak. In the public markets, if a company fails, you see it on a ticker tape instantly. In private credit, everything is opaque. Today, large firms are often owned by a private equity fund and financed by a private credit fund. This means everything about their financials and their performance is effectively invisible to the broader market. We are flying blind. These private lenders are not required to meet certain transparency standards or reporting standards that banks have. There is no daily mark-to-market. There is only the mark-to-model, or what I call mark-to-fantasy. 2. The incentive to hide. Because of this lack of standards, lenders are effectively incentivized to hide the true performance of their portfolio companies that may be in distress. If a borrower is in trouble, a bank might have to write it down. A private fund? They might just lend them more money to pay the interest, pretending the loan is performing, to keep their own valuation high. This is amend and extend. It works until it doesn't. 3. The regulatory gap. Regulators have already allowed this industry to grow this fast without proper regulation. The SEC is probing rating agencies, and the Bank for International Settlements, BIS, has warned that the flood of money, especially from insurance companies, may be inflating creditworthiness and hiding risks. But regulation is reactive. They are building the fire station after the house has already burned down. 4. The deterioration of underwriting assets under management in private credit have tripled over the last decade. Funds are fighting aggressively to win deals. When you have too much money chasing too few deals, what happens? Lenders are being pushed toward looser underwriting and rosier assumptions. Both are bad things. We are seeing deals get done today that would have been laughed out of the room 5 years ago. 5. The single point of failure. Nowadays, in some cases, the only firm willing to give an investment grade rating is a single, smaller agency. This is grade inflation at its finest. You shop for the rating you want, you get the stamp, and you sell the debt to a pension fund that doesn't look twice. This is the new area of the global credit landscape. Massive growth, rising influence, hidden leverage, and risks spread across multiple funds and industries. So how does this play out? Let's run the simulation for the next 12 to 24 months. PIMCO's chief investment officer explains that rapid loan growth has historically preceded asset quality deterioration. This time is no different. Phase 1. The squeeze. As the economy weakens further, credit losses begin to climb. Those 1 in 10 borrowers deferring interest turns into 2 in 10, then 3 in 10. The extend and pretend game hits a wall because interest rates remain higher than these zombie companies can sustain. Phase 2. The unraveling. When these firms finally do file for bankruptcy, that is when the system starts to unravel. Suddenly, the invisible losses become visible. The private credit funds have to mark down their assets. Phase 3. The contagion. Here is where the unusual loop kills us. The banks, holding $1.2 trillion in loans to non-depository financial institutions with $300 billion directly to private credit, get the call. The private credit funds need cash to meet redemptions or margin calls. They draw on their lines of credit from the banks. The banks, seeing the stress, try to pull back. Phase 4. Systemic shock. Systemic risk emerges to larger banks and smaller banks alike. The essential question, whether banks are sufficiently insulated from these risks, gets answered with a resounding no. As recent bankruptcies have shown, even secure loans can fail when underwriting breaks down. The collateral backing these loans turns out to be worth a fraction of the valuation. This is the warning sign. Once this house of cards, the private credit industry, starts to unravel, it could be that the 2008 financial crisis starts looking not quite as bad. Why? Because in 2008, we knew who held the mortgages. Today, the risks are no longer concentrated in banks but spread across multiple funds and interconnected through a variety of institutions. The web is more complex, meaning the chain reaction is harder to stop. We are looking at a bubble. The risk that there will be a bubble in private credit is very, very high, and it is actually getting worse. The systemic importance of the private credit sector is growing. We are talking about hundreds of billions of dollars, $1.2 trillion. There must be a better way to handle it. There must be more oversight. But until regulators expand their supervision to include these large private credit funds, you are on your own. Regulators have yet to prepare for the possibility that stress in private credit could spill into the broader financial system. But you can prepare. The verdict: confidence in this market is likely misplaced. It may lead to billions in losses. There's a lot of opportunity to make money in private credit, which is why it is so attractive. But there's an immense risk associated with it too. Here are what you need to do. Do not outsource your judgment. Do not trust a rating just because it's printed on a PDF. The amount of money flowing into private credit is going to balloon even more, which means the climax of this story is still ahead of us. Whether it happens tomorrow or a week from now, nobody knows. But the physics of finance are undeniable. Leverage plus opacity plus deteriorating quality equals to crash. Let me know what your thoughts are on the private credit dilemma. Do you think this loop between banks and funds is sustainable, or are we watching a slow-motion train wreck? I would love to hear from you in the comment section below. Support my work if you want to stay ahead of this curve, and I will see you back here tomorrow to help you navigate it. Take care.